All right, let's begin this panel. First of all, I would like to thank the panelists. We have three industry experts that are going to be here to talk about FinTech. We have Igor Kozhanov, Jeremy Ko, and David Mills. The panel is going to be structured in this way. We will spend about 5 minutes. The panelists are going to introduce themselves, and then we'll talk for 45 minutes, and then we will leave the last 10 minutes of the hour together to open it up to the audience for Q&A. So my job is the best job. I just get to ask questions, and so let's begin with the 5 minutes introduction. Igor, do you want to start?
Thank you, Cesare. Thank you, Scott, for invitation. And let me open this. So I'm a senior financial economist in Division of Economic and Risk Analysis of Securities and Exchange Commission. Before joining SSC, I was on the faculty of University at Buffalo in the finance department. And currently at the SSC, I work on a variety of projects, including rulemaking, economic analysis, rulemaking, risk assessment, some enforcement, and a lot of work on international affairs. So kind of subject matter wise, I work on financial stability, FinTech, fixed income securities, asset-backed securities, and credit ratings. But as many of people on this call, on this panel know that in SSC often job chooses you and not you choose the job you work on. So with that, let me hand it over to the next panelist.
All right, Jeremy.
Hi, my name is Jeremy Ko. I'm the head of model governance at Upstart, which is a machine learning-based consumer lender. My job is essentially to govern the model, to make sure that it's well controlled and documented. And I also do communications to various parties about how the models work and issues related to governance, such as explainability and fair lending. I was formerly an academic in the finance department at Penn State University and was at the SEC for about 11.5 years, hence the connection to this particular group. And while there, I did some work related to consumer FinTech, and that's how I ended up where I am in industry.
Excellent. Thank you, Jeremy. David?
Hi, I'm Dave Mills, and I'm at the Federal Reserve Board in Washington, D.C. I am an economist by training. I have responsibility for economic research related to payments and payment systems. I do also have responsibility for our innovations, work in the area of payments, as well as our retail payment systems. My PhD is from Penn State University, so there's a connection with Jeremy there, although in the economics department, not in finance. And I've worked with Igor on a few things in international work, so there's my connection with Igor as well. So, but yeah, I think how I sort of got into this job as it came out of academics at a postdoc at Purdue University, and then worked at the Federal Reserve Board for the last 19 years, but on a range of topics, both of an academic nature as well as a policy nature.
All right, thank you all. So let's begin talking about FinTech. Obviously, FinTech encompasses many different areas, and we are not going to be able to talk about all of them. But because of the expertise we have here on the panel, let's begin talking about consumer lending and machine learning. So let's begin with Jeremy first. Jeremy, would you mind explaining just in broad terms what lenders can or cannot do when they determine the credit risk for applicants in terms of explainability, fair lending, and so on? So one question I have is, can a credit lender use Facebook data? Can they use geolocation from the smartphones? So what can they use and what can not use?
So there are some regulations that govern our use of data, including the Fair Credit Reporting Act, which restrict access to certain kinds of data. Not being an attorney at the firm, I don't know exactly where the legal bounds of this are, but I do know that we have explored the use of various kinds of attributes that are out there in public records and that not all of them are FCRA compliant. That's the Fair Credit Reporting Act. So there are some bounds as far as which data we can use. However, that said, we do use quite a bit of alternative data, which applicants report as part of their loan application, both explicitly and implicitly. So stuff that we observe about their online behavior and stuff that they actually explicitly say in their application is, those are both characteristics that are germane to our models. And there's a whole host of regulations that control exactly what we can do and how we do it, including the Equal Credit Opportunity Act, which is also known as ECOA, that basically say we can't have a disparate impact on different kinds of protected classes, including various kinds of minorities, women, and people over the age of 62 with our credit lending decisions, and that we also can't treat these various kinds of parties disparately. And one requirement that these regulations impose, or ECOA and FCRA in particular, is the requirement for an adverse action notice in the case of a credit denial. And what that essentially is it's a letter that gives a number of reasons which specify why that particular applicant was denied. And although these regulations don't directly constrain the interpretability of our model or the explainability of our model, they do compel us to use certain kinds of interpretation methods in order to say what the reasons were associated with an applicant's denial. Now, these machine learning models, these machine learning methods have received a lot of discourse, and some of them include things like surrogate models, which are simpler forms of, let's say, linear models, which approximate the more complex nonlinear model that we have. There's things like feature importance methods, which tell us what the marginal impact of a particular feature is on a particular outcome. And, so because our model is complex, it's nonlinear, we have to use these models in order to say what the reasons were. Are
you also going to use the models the simple model to approve or deny the loans, or are you going to just use the more complex deep learning model for approval, and then you use the simple one for explainability?
It's the latter. It's the latter. So we use the complex one for all the credit decisioning, for figuring out what the interest rate is. Our model basically tells us what the predicted probability of someone's default and prepayment is, which affects the value of the loan. And then we use a simpler model in order to interpret the more complex one. That's essentially how the process works. Okay. And one of the positions of Upstart's leadership is that, if you want to think about interpretability, there's been, a lot said about how black box models aren't very interpretable, but simpler linear models may be. But if you go to a definition, of interpretability that maybe relies on rationalizability, like, can we rationalize the relationship between this variable and that variable? Then simpler models may have the same kinds of problems. And these interpretation methods are becoming more commonplace in industry.
I see. And so when you talk about regulators, there is a host of regulatory agencies that oversight this process. So who do you usually talk to? Do you talk to the Cfpb, to the so who are the main agents here?
Yeah, so Upstart is an intermediary. We do the underwriting model, but we don't actually make the loan, so we're not a bank. So okay. And thankfully, the regulatory structure is such that there is a regulator that oversees us, and it's the Cfpb. And so we have a lot of discourse with them about how we ought to do our fair lending testing program. We're kind of at the cutting edge because we're the only algorithmic lender with a no action letter with the Cfpb, which specifies exactly what kind of statistical tests we need to run to assess the fair lending impact of our models, controlling for credit characteristics. So we're kind of setting the stage for, I think, what's going to become more commonplace regulation for algorithmic lenders in the future. But we do have to deal with other kinds of banking regulators oversight, like the FDIC, because we don't fund the loans. The banks, our banking partners, do fund the loans, and they're overseen by regulators like the FDIC. So we have to deal with their regulations indirectly as well.
So when you said you got a no action letter from the Cfpb, can you explain a little bit more what that means?
Yeah, so a no action letter essentially says that they're not going to come after us. So they're not gonna, they're not gonna investigate us. They're not going to examine us subject to us complying to this letter. And this is kind of the terms of this letter are mutually negotiated in sort of this bilateral process between us and them. And the letter specifies exactly how we ought to do our fair lending tests and what happens in such and such contingency if we fail a fair lending test. How are we going to test the model and determine whether or not there's a better model that we ought to use from a fair lending standpoint that's not going to sacrifice accuracy. So the NAL essentially lays all this stuff out.
And you mentioned that you are the only company that received this no action letter. So the other companies are more navigating in a more like a gray area.
They're more overseen by the traditional kind of regulatory process. Traditional regulations. Reg B, ECOA. Disparate impact and treatment, however that's interpreted, case law. And by the typical exam and investigation process, where we have this no action letter where we meet with the Cfpb on a monthly basis and we talk about what we found, whether or not we should make modifications to that no action letter. And so we've got an ongoing consistent dialogue with them to make sure that we're doing the right thing with respect to fair lending.
So we're all economists here, and so we always think about regulation as a balance between the cost of regulation and the benefit of regulation. Do you have a sense of how is there a gateway loss when it comes to modeling and regulation of modeling? Could you run a much better model, but you can't because of regulation?
Well, thus far, I would say that regulation hasn't imposed a big burden on us, because the regulator and the case law basically says that, if there's a business impact, if there's a big impact on accuracy when it comes to our model, that can give us grounds to have some kind of a disparate impact on certain protected classes. So in other words, if we, if what we're doing is identifying additional credit risk, but it correlates to race in some way, well, that's okay, as long as there's not an alternative model that gives us the same kind of prediction of credit risk without correlation to race. So I would say that it hasn't had a big impact on us. But even if there's some kind of small impact on accuracy over time, my assertion would be that it's not clear in the long run. So in the short run, there may be some deadweight loss from regulation, in the sense that, let's take a really naive, simplistic example where we pull out some credit attribute that correlates to credit risk, but also correlates to race as a result of fair lending regulation. Well, that might have a deadweight cost in the sense that our models become less accurate and we can't provide credit to as many people as a result. But in the long run, this might be an okay thing, because certain thin credit application people from these protected classes may get more access to credit as a result. And our models and other models can learn about those people instead of them being pushed off into this gray area, this black area, where no one ever knows what their true credit risk is. So in the long run, these kinds of regulations can actually, have a social benefit, even, if you look at the entire pie.
I see. And I don't know if this is confidential information, but would you mind describing in general terms how your models are?
Yeah. So, unfortunately, I can't say anything about this, what's in the secret sauce exactly, but we do use a set of fairly standard textbook machine learning models. And the secret sauce comes from the fact that they're combined, they're ensembled, and they're specified in such a way to maximize predictive accuracy. And the big, coming into Upstart 6 months ago, I was like, well, what's so special about this firm? I mean, this seems like something that anybody could do. They could get some credit data, they could get some alternative data, they could use these standard machine learning models. You can put the two together and you can make a better prediction than a traditional credit model. What's so special about Upstart that allows us, what's the comparative advantage? Yeah. Well, in my view, the comparative advantage is the fact that we started before everybody else. So we've got about 300,000 loans at this point. That's about 9 million loan month observations. And over time, we've learned how to engineer our features, our inputs into the model, and engineer the model to specify the ensemble in such a way to maximize predictive accuracy based on these 9 million observations that other people don't have. And essentially, I think that's what the big comparative advantage is.
So people don't have so the other banks don't have the attributes or the data. So is it the alternative data that you have that other companies don't have, or is it just the actual observations that they don't have?
So it's some combination of the two. They either don't employ the nonlinear models. They don't have the detailed data that we have. I mean, we have actual loan month observations as to, we don't just say, oh, this person defaulted over the course of at some point over the course of a 5-year loan. We say exactly, well, here's what their payment pattern looked like over that time. So we have, very micro data, very granular data on repayment behavior. We have alternative data, and we have a lot of loan observations and put together that within one of these nonlinear ML frameworks equals greater predictive accuracy.
Yeah. So one last question, which is a little out of the blue, is more, so, over the last year and a half, things have been very different and special with COVID. How do you, think about like the new behavior? It seems like there is some kind of structural change because of COVID. How do you embed into the model?
Yeah, so that's a really, really good question. So, in my time, I've discovered that there's some things that machine learning models are pretty good at, and some things that they're really not good at. And one thing that they're not good at is if you've got a low number of observations when it comes to, something like most of our loan portfolio, if you take the COVID period out, was during economic expansions and not during recessions. And so the model, as a result, is not going to be very good at saying what's going to happen during a recession. And there's similar other kinds of things where we have a low number of observation when it comes to a certain thing. And the other thing the model isn't very good at is determining causation. I mean, it really tries to sense correlates and nonlinear correlates to the outcomes of interest, but it doesn't say anything about which ones actually cause what we observe and which ones don't. And the thing that we have to do, with these things, like, for example, low numbers of observation, is we have to tweak the model. We have to figure out some way to tweak the model in order to get the model to say the right thing. And typically what that means is, taking the output of the model and adjusting it in some way after the fact to account for the fact that we have low data, in certain respects. So that's yet another thing I've learned, is that these models are quite imperfect when you don't have a really, really big sample of what you want to observe, and so it requires some human engineering around it. Okay,
excellent. Thank you, Jeremy. Now we spent 20 minutes talking about consumer lending and machine learning. Next big topic is cryptocurrencies and especially central bank digital currencies, CBDCs. And David here is an expert of payment, and so he can help us understand a little better, what are CBDCs good for? How are they different from a credit card or the digital money we currently use? So David, do you want to start giving an introduction about what a retail CBDC is and why there might be some benefit in using or not?
Sure. So first, I guess to start off with a somewhat simple definition of a central bank digital currency. Think of it as a direct liability of the central bank that is widely accessible to the general public. So that's what I think when you use the word retail, I might use the word general purpose, but it's basically widely, I think the main point is it's widely accessible, and it's a central bank liability. So today that comes in only one form, and that's physical cash. We also have a very robust network of digital money, as you note, and that is in the form of reserves at the central bank. But those reserves are limited to eligible financial institutions, so mostly banks and a few other special cases. And it's through the banking system that, the functioning of credit and credit and payments infrastructure and payments provisions all kind of fall down from that into this sort of commercial bank money ecosystem. So most of our digital money that individuals, consumers, firms, etc., will receive or interact with is commercial bank money. And so really, like, the central bank digital currency is kind of this nexus of a central bank liability, not a commercial bank liability, and widely accessible. So that's the kind of the starting point. So that's kind of what we mean here. And then you sort of ask, well, what is this potentially good for? And that's a good question to ask, because as we would sort of note, there are a lot of the U.S. in particular, and lots of other developed economies have a very robust electronic payment system. There's a lot of very rapid activity. There's very instant delivery of payments. There's a lot of modernization in infrastructure that provides a lot of safety and efficiency around existing payment structures. So the question is, can CBDCs offer something beyond that? And that kind of falls into two things. Like, one, are there technological improvements that could be made by the introduction of central bank digital currencies that continues and provides even additional enhancements or functionalities? That's a question. Or two, can it broaden the range of access to individuals to direct liabilities beyond physical currency, under some expectation perhaps that physical currency may decline or disappear over the long term, and the general public would not necessarily have access to that physical currency. So those are two sort of high-level types of benefits that are often advocated. But I think Cesare, you get the real question is, how does this improve over and above our existing very digital and very functional economy? And so there, I think you have to kind of go beyond the high-level surface of these sort of efficiency arguments and start to think a little bit about whether there are additional considerations. So one is on the technology front, and that is around stable coins and other new digital forms of money. You could kind of lump cryptocurrencies in there. Cryptocurrencies are a little bit unique in the sense that they're an alternative to the dollar, whereas in stablecoins, at least those that are intended to be used regularly as a means of payment, and perhaps also as a more safe store of value, are denominated in the dollar. And so there are these fundamental questions about what do these things look like? Are they sort of substitutes for existing electronic forms of money, such as bank deposits? And if so, how could they be potentially utilized, designed, regulated in a way that allows for enhanced functionality of the technologies used? So some combination of distributed ledger or cryptography and other types of potential innovations around programmable money and other types of automation and smart contracts, right? So there's on the one hand, there's these questions about how can the private sector adequately, safely provide something that's inherently linked to the dollar and inherently assumed to be very comparable to a bank deposit through regulation and supervision. The other alternative is to think about, well, even in that guise, is there a need for a central bank digital currency alongside that? One of the things that you get with sort of private sector developments is you get closed networks, you get kind of walled gardens. These walled gardens can proliferate and create some confusion, so we all have to be connected to the same networks in certain times. And that can be clunky, or at least restrict or prohibit some of the applicability of these things. And central bank digital currency can provide an alternative way to kind of connect those through either infrastructure enhancements or as an alternative for consumers to use as a way to provide a little bit more ubiquity. So these are some examples that kind of as a complement or alternative to stablecoins is one additional benefit that people think about. And then the other is maybe more geopolitical, and that is kind of tied to more macroeconomic objectives around monetary policy and financial stability, and how that the dollar's role as an international reserve currency, and a lot of questions around modernization efforts that might be happening at other central banks and other jurisdictions, and does that sort of adversely impact the role of the dollar, the U.S. Position in the U.S. in the global international markets, et cetera. So that's not necessarily an economic argument, but it can be a little bit more geopolitical. But that's another important consideration, because tied to that are things that get into more public utility and public interest, national interest types of questions around national security, around the future of global financial markets, around the ability to prevent illicit finance. So there's a number of complications beyond the sort of fundamental economic efficiency arguments that I think kind of get into play in that kind of conversation. So those are some of the highlights of the possible use cases. This is not necessarily, I don't necessarily advocate any view that one or dominates or they all work or not. But these are when we talk about these amongst ourselves in the central banking community, often these are the types of things that we land on, among a few others.
So we know that China is already experimenting and piloting CBDCs, the digital yuan. Can you give us an update on where the US is in terms of thinking about developing a CBDC?
Yes. So the Federal Reserve Board here is about to issue later in the summer a discussion paper that kicks off a series of conversations around central bank digital currency and the future of money and the future of the sort of money and payment system of the future, and whether or not there is a need for a central bank digital currency. So we are actively moving towards a public dialogue around the need for and potential design aspects of central bank digital currencies. So that's sort of a first step that we have. Behind the scenes, though, we've been a bit more rigorous in some of the experimentation around different technologies for central bank digital currencies. Perhaps the most high-profile one of those is a partnership between the Federal Reserve Bank of Boston and MIT, where they are looking at, I think, scalable ledger platforms that are, I don't necessarily want to call them distributed ledger platforms, but they're sort of take certain elements of the distributed ledger platform and combine that with some centrality that leads to questions about, can these things scale? Can we use new platforms to scale rapidly for a general purpose CBDC infrastructure? So that's one area of experimentation. Another area of experimentation that's going on is related to interoperability and how do you build a central bank digital currency that might work on both new and legacy platforms. And so what would that look like? What are the conditions around that, both from a technology perspective, but also raise the awareness of some of the policy issues. And then thirdly, we've been engaged very heavily with our international colleagues on central bank digital currency topics. We're part of a group that's closely affiliated with the G7 countries, looking at common language and common grounds about how these things might be developed. There are implications that I mentioned for cross-border. What are some of the foundational principles around thinking about central bank digital currencies? More broadly, we're engaged with a broader set of G20 central banks around the future of cross-border payments, as well as leveraging new technologies like central bank digital currencies. So there's a lot of engagement that the Fed does also have on that front.
Also because I guess these CBDCs, they have to be interoperable among themselves at some point.
In principle, I mean, a lot of people see promise. So cross-border payments is an area where there are a lot of pain points. Some of you may have very direct experiences with that. They're clunky, they're slow, they're time-consuming, they're expensive. There's a lot of toll taking. And so there's some foundational question about whether new technologies and new designs can help centralize, simplify, provide lower cost access. And central bank digital currencies is one of several tools being considered for this in the long run. And to your point, interoperability, or at least sharing of platforms for them to exchange more easily, particularly at the retail cross-border level, are certainly interesting parts of the dialogue. And so there are these needs to kind of think a bit about how, if CBDCs are often viewed internationally as a greenfield opportunity to build something from scratch, and it maybe try to resolve some of these issues up front. But obviously, it's more than technology. It's also a lot of diplomacy and negotiation.
Yeah, I mean, one of the big disruption I see for the introduction of CBDCs is in the banking sector. So now people are concerned that if people deposit their money directly into the central bank, then they're not going to put it into the banks, and banks are not going to have the funds to provide loans and so on. Now, from a corporate finance professor perspective, I understand Modigliani Miller. I understand that if they cannot raise debt, they can just raise equity to provide these loans. And one of the advantages of having a CBDC, in my view, will be that actually there is no more deposits, and therefore there is no need for deposit insurance and all the regulation that are attached to FDIC deposit insurance. So now, if you think about an all liquidity bank, there might be much less regulation involved because now you don't have to protect depositors. Is the Fed concerned about the lack of deposit funding for banks in the case of introduction of CBDC?
Yeah, I mean, this is definitely one of the top of mind issues to think about, and some of that can be potentially addressed through design. So that the sort of next layer is if you were to build a central bank digital currency, how would you design it? And that's where the details start to get tricky and delicate, trying to achieve a host of objectives. But I do think that disintermediating deposits is something that people think about. To your point, there are ways in which the markets can adapt to that. And it also depends on whether or not we really do think there's a need for a general purpose central bank digital currency, or really are we providing new infrastructure and a central bank digital currency that enables more commercial bank digital currency, if I could use the phrase, that just really replaces the way we conduct payments onto new platforms and new ways to do things. That's more of a technology story where maybe disintermediation would be less of an issue. Our colleagues at the ECB tend to think a bit about, ways to handle disintermediation is through the imposition of some limits. Like you can do your holding, you can limit holdings. There's some pros and cons to that. I'm not entirely convinced that that's a viable answer, because once you impose limits on consumers and consumers are aware of these limits, you may actually exacerbate runs away from bank deposits in certain ways, or at least put additional stress. So in the aggregate, you might be able to handle that, but there might be additional pressures that you would have to deal with. So the third model is, there's a lot of lip service, at least, to saying that any central bank digital currency would be intermediated. Now, what does that mean? So that would mean that any distribution model for central bank digital currencies to the general public would largely go through the banks. Well, how do you do that and not call it commercial bank money? I think is a interesting question. It's a potentially legal question about how one creates a liability that protects consumers from credit risk of the bank, but has some kind of direct claim to the Fed in times of both normal and stress times. So these are thorny issues. They're not necessarily easy issues to address. Some of them would require legislative change in terms of how you might define liabilities. But these are all the kinds of questions we plan on posing in our discussion paper when it comes out early next month.
So you're saying that there could be a situation in which the bank can lend out your deposit, your central bank digital currency, but it still sits in the central bank liability? So like hybrid model.
Yeah, some kind of hybrid. It all depends. And I think once you start to try to seriously map how that looks, there are a lot of thorny issues to figure out in terms of how implementable something like that would be. What sort of legal requirements would you need? Are there ways do you have to design it a certain way? And even with all of that, it may not be achievable in some sense. So that's why I said, the end game, if we think of it about the future state, the future state might be some combination of a central bank digital currency, much like we have reserves today, maybe relabeled on different platforms or new technology, that supports an architecture of commercial bank money that's digital, or digital central bank or commercial bank money of a new type, that might leverage some of the features of stablecoins or complement or use platforms that stablecoins have in a way that works a lot like we have today. And these are all like up in the air. I think the point is that there's a lot of change, a lot of conversation. They reintroduce existential questions about the role of money, the role of the private sector. Are banks, is it the banking sector that's the full set of intermediaries? Should we be considering additional types of intermediaries that might have special licenses but not full-on banking licenses? How do we think a bit about not just the design but the distribution? Is there's a lot to actually unpack there.
I mean, one last question, and then we're going to move on to the next topic. Is so we are not the first mover here. The first mover is actually China. Do you have a sense of how they are addressing all these concerns? I mean, they're already piloting it. People are already using in small situations these digital currencies. Do you have a sense of how they are resolving this issue?
So a little bit. I mean, details are not always easy to obtain, but one of the things, as I understand it, is much of what they have done is establish a platform improvement and an instant payments network that they required the major FinTech providers, so Tencent and Alipay, to go through the traditional banking model. So it's labeled as a CBDC. I'm not necessarily convinced that it meets all the properties that we might think about, but it is like an infrastructure improvement with some legislative, with some sort of requirements associated with the private sector providers going through the more traditional banking sector, which, as I understand it from the conversations with them, is what they had been most concerned with, is that the Tencent and Alipay were getting such a share of dominant position in the marketplace for payments that the banking sector was actually more threatened, and there was a need to take action. So that's where this argument about, not that they were stable coins, but this argument that central bank digital currency that complements or offers an alternative or a way to sort of leverage or establish some balance around liability structure and the protection that consumers often get through banking carry through. So whether it's being called a CBDC, it may be there, but even if we follow some of the statements about whether this is actually a new instrument that's a liability of the People's Bank of China, the public statements are conflicting. Some say yes, some say no. So I'm not entirely sure if they're really truly first moving, but they certainly are trying to offer a way in which that payments ecosystem operates through digital platforms.
I see. All right, thank you, David. I want to continue on this topic about digital assets and cryptos with Igor. So Igor, lately the chief of the SEC, Gary Gensler, has talked a lot about regulating crypto markets, what the SEC can or cannot do. So currently, what are the investor protections for people investing in cryptos?
Okay, thank you. Before I start talking, I would like to say standard disclaimer that what I'm about to say reflects only my personal view and not the views of the commission, commissioners, or commission staff. And if I mention any specific instrument or market participant, it doesn't mean any endorsement of that instrument. It's only for illustration purposes. Okay, so kind of before addressing your question, let me talk a little bit about SEC mission and how kind of this mission it plays out in practice. So first of all, if you look at our mission, the mission is to protect investors, facilitate capital formation, and maintain fair and orderly markets. Additionally, as members of Financial Stability Oversight Council, we have certain responsibilities with respect to financial stability of US financial system. So as you see, investor protection is the first and foremost, the first item in our mission statement. And a lot of what we do is with the view of investor protection in mind. So, however, how kind of decisions are made about, approving or disapproving certain instruments or rules or whatever? Well, there are certain principles, certain criteria, and those criteria stem from our mission and the body of rules and regulations and laws that we have in financial markets. However, the second input into our decision making is what's going on in the market, state of the market, how it changes, and therefore, even if we apply the same criteria, the same principles now, 5 years ago, and 5 years from now, outcome might be different, simply because the world has changed and the markets have changed. And with that, kind of, you need to look at crypto markets as well. And markets change, and crypto markets change probably faster than conventional financial markets. And that's part of life. It's part of our decision-making process to observe and to learn what's going on in the market. And when you look at decisions commission staff make, you need to keep in mind these two fundamental principles: our mandate and rules, and what's going on with the market. So one thing I would like to mention in this regard is that we really cannot tell investors what risks to take. Investors are free to take any risks they want. And for example, I cannot say that Bitcoin is very volatile asset, and it's probably not a good investment for your retirement portfolio. And I can prohibit investment vehicles based on Bitcoin based on this observation. However, if Commission observes that Bitcoin or any other crypto or any other digital asset is potentially prone to manipulation or prone to other types of fraud, or might be used to take advantage of investors, then this is a reason for our concern. And kind of with that, again, you should keep in mind that you need to separate the volatility and appropriateness of cryptocurrencies for investment portfolio versus potential concerns about fraud, market manipulation, and general investor protection issues. And the final thing I would like to mention here is that we work in close cooperation with market participants, and we have open channel with market participants. It's not adversarial relationship. We want markets to succeed. We want capital formation to succeed. We want investors to earn returns, well, commensurate with the risk they take, but we want to help market to thrive. And market participants in crypto space, they also want the same. However, again, we both don't want market to be subject to manipulation, subject to fraud, and we don't want investors to suffer. So that's kind of a two-way process, and I hope it is cooperative. So here, kind of going back to your question about what investment protection concerns we have, I would like to kind of give a couple of examples. So if you think about Bitcoin, it seems like there is a lot of data about Bitcoin. There are a lot of trading platforms, a lot of sites where you can download like entire blockchains and all the data, all the trading and everything. But fine point here is that, well, how good is that data? Does it even exist? In the sense that, does it reflect any real economic activity? If you see that currency X was traded against digital currency Y at platform Z, did any economic transaction actually happen? Or somebody just printed this transaction in tape of that exchange, of the trading platform? And here comes a very important part of our job, actually. And here, I know that we have a lot of PhD students here. That might be important for them to know, is that kind of what I would call forensic econometrics or forensic statistical analysis of data is actually a very important part of our job. And if you see that some data, some information about crypto looks like it was artificially generated by a bot or by some computer program, well, that tells you a lot about state of the market, actually. It tells you a lot about the fact that, well, probably a lot of this market doesn't even exist. And a lot of statements about, protection of investors in that market might not hold water simply because the market is not there. So
algorithmic trading is extensive also in securities market. I mean,
yes, but it's somewhat separate issue. So algorithmic trading is somewhat separate issue. It's not really related to crypto markets. So again, one of the issues is that a lot of information about that market, about these markets, is not verified, is not even verifiable, I would say, and that creates concern about potential ability to manipulate the market, because not many people can understand that price that you see on the screen might not reflect anything. It might be just somebody wants to pretend that this is the price of that asset. And unless and until we can verify at least some of that information, well, we might not be able to really understand the market, really protect investors in this sense. So another kind of big investor protection issue is related to kind of smaller digital currencies. And if you look at the current landscape of digital assets, yes, of course, everybody heard about Bitcoin, Ether, maybe a couple of others, other assets. But well, if you look carefully, there are like thousands of those assets, and most of those assets, well, they very obscure, and a lot of them look like, your classic penny stock or penny stock pump and dump setups. And that's another kind of investor protection issue that we regularly have to deal with, like outright fraud, but using digital assets rather than penny stocks of 10 years ago.
No, I mean, I agree with you. I think most of the fraud and the rug pull that happens, it's not in Coinbase or in the Bitcoin ledger. It happens in very highly decentralized small cryptos. They're not even in the US. They're all distributed across the globe, and so the regulatory purview of the SEC it's a tough job for SEC. How to protect investors in the US for product that can be run everywhere in the world.
Yep, that's actually that's a big concern for us, and that's kind of what our division of enforcement has a lot of work to do there.
Absolutely, no, it's a very challenging. It's a very challenging problem, because yes, you can talk to Coinbase, but again, the fraud is not there. The fraud is more in the darker corners of crypto. Absolutely.
But even with that, let me kind of go back to Bitcoin. So Bitcoin markets somewhat split into, I would say, 3 parts. One part is somewhat regulated, actually very regulated. It is Bitcoin futures, which are traded on several, actually now one exchange in the US. And it's also regulated by our sister agency, CFTC. And again, there is no doubt about kind of level of investor protections there. Then there are spot markets, Bitcoin spot markets, which some of them are more or less lit markets and visible and complying with relevant regulations. And again, I don't have a lot of concerns there in terms of potential fraud. And then there are, as you said, overseas markets, which are who knows where. And who knows even if they exist, as I said. So the question is, if you look at this market as a whole, which part of that market is dominant? Which part of that market drives the other two? It's a very good question. And again, that's another thing that we are quite interested in, and that's probably good work for good task for a good economist, curious econometrist. Look at these markets. Look at who drives whom. Where, if something happens here, is it reflected there, and vice versa. So that's kind of actually one of the good questions we have right now, and the market has right now. And we might find a good topic for your thesis or research project or something like that.
So Elizabeth Warren, about a week or two ago, made a comment about it's unclear, who is the regulatory agency in charge of regulating crypto markets. Can be the CFTC, can maybe the SEC. And so she was endorsing, building like a joint task force for regulating these markets. Is this? I don't know if you can disclose this. Is this something that the SEC is looking into?
Oh, well, definitely. So this is kind of very important observation that digital asset markets kind of fall in between many regulators. So, for example, payments would fall within Federal Reserve purview. Derivatives would fall within CFTC. Initial coin offerings would fall, or investment vehicles would fall within SEC. But there is no single regulator which regulates everything in the digital asset space, and it creates kind of possibilities for regulatory arbitrage. And I understand this observation, and to be honest, for us, maybe not for me personally, I'm an economist, not a lawyer, but for SEC as an organization, it's always has been reason for frustration, because it's not clear what we can or cannot do. And well, in certain cases, maybe some act of Congress might be useful here. But again, I'm talking only my personal capacity, not as a representative of an organization. So it might be time to consider this new space. It's kind of informed enough to warrant some creation of some principles that would eliminate these loopholes and eliminate this regulatory arbitrage that, let's be honest, exists in this space.
Thank you so much, Igor. So now we have about 7 to 10 minutes to open it up to the audience and see if you have any specific questions. We talk about 3 main topics. One is consumer lending and ML. We talked about CBDCs and also digital asset and cryptos. Anybody?
So I have a question. So basically, I kind of want to link what Jeremy said with what Igor and David said. We know, in the private sector or in the FinTech companies, there's been a lot of usage of those new techniques, new machinery models, and it has been also a lot of research papers in academia. I'm just wondering, for regulators, do you kind of also employ a similar technology, for example, what we talk about in terms of detecting fraud and those kind of things? So could you talk about what's your perspective on using those techniques or new econometrics models from a regulator's perspective? Thank you.
I guess I'll start here. Well, of course, we do use these techniques. However, I would like to mention that there is still a lot of room to use more traditional techniques to figure out to find potential fraud or potential issues in the market. So, but yes, we do look into those machine learning, for example, as part of our work. And some of that is being deployed as part of standing work in finding certain types of fraud. I cannot tell you which ones, but it is being deployed. It is being worked. It is being used for actual work. However, again, the work of both SEC attorneys and SEC economists is kind of very, very multifaceted. Some work is based on good old tools, and some work is based on good old whistleblowers, tips and complaints from marketplace, and some is based on more sophisticated statistical techniques. So that's what makes our job very exciting and actually difficult.
I guess I might add, right? So you're kind of referring to a little cottage industry called soup tech, or using technology to facilitate supervision. And there's also a complementary reg tech, which sort of helps financial institutions develop tools and techniques to help comply with regulation and supervision. And in each of those cases, right, I think as Igor said, right, you've got your existing and new tools, and certainly all of these things are worth pursuing and exploring. I'd say one of the areas that's interesting from an AI perspective is a lot of it is on compliance with illicit finance. Know your customer rules. So there's a lot of cost associated with complying with anti-money laundering, know your customer types of rules, and so there's a lot of desire for banks to innovate or use innovative new technologies to simplify that process. Some of that requires the regulators to also accept those forms. That's also an open question, and so part of the answer there is that supervisors need to become familiar with those tools themselves if they're able to kind of have any degree of confidence that they're effective or improve upon existing compliance methods to change rules or policies as needed. But then similarly to use the same kind of tools for their own job, which a lot of that might fall in enforcement. So again, I think there are ample opportunities.
Thank you.
All right. Any other questions here?
Igor and David, I'm wondering, you guys mentioned you cross paths on international meetings. I wonder if you could just say something about how regulators coordinate across jurisdictions when dealing with issues like this.
Yeah, it's a good question. And actually it relates to one of the questions that Cesare asked about crypto space and how different regulators kind of overview different parts of the space. So within United States, we have Financial Stability Oversight Council, and a lot of work is coordinated through them, including in the crypto space. And we have a lot of work together between Treasury, Fed, Cfpb, CFTC, SEC, and so on and so forth. So in the US, we have constant contact with respect to many issues, including digital space. Internationally, there are a couple of kind of well-known organizations which facilitate international cooperation, and probably the biggest one is Financial Stability Board, which kind of both David and I participated in work on some of the committees of that Financial Stability Board. The purpose of Financial Stability Board is to facilitate talking between different regulators, between different jurisdictions, and to create a forum for that conversation. And FSB is not just a single committee or single forum, but it's rather a multitude of fora where people talk about open-end funds or fintech or financial stability in general or payments or whatever is an important topic of the day or standing topic, which will always be there. Kind of these conversations are very important for us, kind of both, I hope, with the Federal Reserve and the SEC to understand the positions of others and to arrive to something that would be helpful for financial stability, both domestically and globally.
And I would say, in addition, there are a number of standard setting bodies that try to come up with standards around broad financial topics, and there are a number of them out there sort of organized loosely. FSB is kind of an interesting perspective because it kind of brings all of these different areas of finance together under the financial stability umbrella and focus on those issues. But underneath that, you have, say, the Committee on Payments and Market Infrastructures, which is a payments standard setting body. And there's also a complementary one for markets regulators where the SEC and CFTC contribute. IOSCO, don't ask me to spell that one out. But then there's also the Financial Action Task Force, which gets to issues of compliance around AML and KYC types of issues, and the Basel Committee for bank supervisors. And so each of these kind of come up with standards on certain issues of cooperation at various points in time. And increasingly, so sometimes those silos work, and increasingly, I think with innovation, a lot of those topics intersect a lot more. The crypto and particularly the stablecoin space is a good example where there is an intersection of payments and banking and markets regulation that and AML compliance that kind of bring that conversation more together, and the need for like thinking about coordinated efforts on those fronts as well. So there's a lot to do and a lot of frameworks to do it in, but I just want to give you a flavor of some of the things underneath that FSB hood, which FSB kind of can brings them all together in some way, because as Igor said, we're all those committees are kind of represented on that.
All right, any other questions?
I have a question for Jeremy. You said that earlier, first mover advantage is what makes your credit process better amongst your competitors. So essentially, it's how many data points you have to better train the algorithm to give predictive modeling. So how do you see the future of credit lending space changing because of FinTech? And do you think the people with the first mover advantage will end up getting the major market share?
Yeah, I mean, I think that well, I would predict that everybody would go to some kind of algorithm in the future. So go to some kind of nonlinear model, because I think it's fairly clear from our loan performance that there's a clear advantage to going to these alternative models. Bringing in all this data, there's all this disaggregated data, and putting them through some kind of nonlinear model. And so if we're at a comparative advantage in providing credit to people at better rates, then we're eventually going to unseat all those traditional lenders that stick to the old framework. So I think it's clear that we're going to be able to do that. Are we going to be able to monopolize the market? Well, clearly not. There's other people with data. I don't think that these things are incredibly hard to do, but as far as the space exists right now, we've been able to capture a dominant market share because there's startups that want to do it, that lack the first mover advantage that we have, and then there's traditional lenders out there that don't want to, out of fear for what this might imply for the regulation, for their exposure to credit risk, that they don't want to venture into that unknown territory of machine learning. But I think eventually that's where everything is headed.
I have a follow-up question. Right now, Upstart operates in personal loan space, but eventually, are these models going to be applied to residential mortgage space, like other forms of credit as well?
Yeah, so we've already got into auto lending, and of course, there's tons of other consumer credit products that these kinds of methods could potentially be applied to, and probably eventually will be applied to. And there's all sorts of other applications of the same kind of modeling as well, and insurance, et cetera. So like I said, I think eventually things are going to converge to this particular approach.
I have another question for Igor or David, I'm not sure who, but is investor protection the main priority when you're thinking about regulating cryptocurrencies? Or are there any other considerations that go into regulation or setting standards?
Oh, of course, as I said, so our mission has three components: investor protection, capital formation, and maintaining fair, orderly, and efficient markets. And of course, when we look into what's going on in crypto space, we look at all three components of our mission and how they relate to that. And kind of, for example, in the space of initial coin offerings, which was very big, huge space 2 years ago or 3 years ago, and not that big now. Kind of capital formation is also very important consideration for us in addition to investor protection. So if you look at our actions, the commission actions, yes, there are a lot of enforcement actions against certain ICOs, but at the same time, there are certain registrations from several ICOs that we allowed to go forward when they complied with all the requirements, and several of them went through so-called registration A, and they became available to the public, to certain segments of the public. And again, capital formation is one of three of our missions, and we look at everything from all three lenses. Yes, investor protection right now dominates our thinking, because again, crypto is a relatively young market and there are a lot of investor protection issues there, but it's not our only concern.
The Fed's role in this is very, very complementary in the sense that it looks at the impact that cryptocurrency activities might have on banks for the safety and soundness of banks that they supervise, and so that can be relayed to questions around the types of activities they might engage in. Does that make them more susceptible to some instability? Are there policy frameworks around that? So that's kind of complementary piece beyond the roles, the investor protection and other issues that certainly fit in the SEC world.
Thank you, everybody.
All right, if there are no other questions, there is going to be a plenary session in 8 minutes about ESG and climate risks. So please join us in 7 minutes in the other room. All right, thank you so much to the panelists and to the audience for asking questions. Thank you, guys.
Thank you.